P/E ratio. Cheap, expensive, or trap? Before you call a stock cheap or expensive, ask what the market is paying for each dollar of earnings. That is what the P/E ratio tries to show. P/E stands for price to earnings. The simple formula is P/E equals stock price divided by earnings per share. If a stock trades at $100 and the company earns $5 per share, the P/E ratio is 20. That means investors are paying $20 for $1 of annual earnings. But here's the important part. A low P/E does not automatically mean cheap, and a high P/E does not automatically mean expensive. P/E only becomes useful when you compare it to the quality and growth of the business. A high-quality company with durable growth, strong margins, recurring revenue, and a long runway may deserve a higher P/E. A weak company with falling earnings, shrinking margins, too much debt, or a broken story may deserve a low P/E. That is why a low P/E can be a bargain, or it can be a value trap. Let's walk through 3 scenarios. Scenario 1, low P/E, strong business. This can be attractive if earnings are stable, cash flow is strong, and the market is temporarily too pessimistic. In that case, the stock may move up if earnings hold and investors decide to pay a higher multiple again. Scenario 2, high P/E, strong growth. This can still work if earnings are growing fast enough to justify the premium. The market may be paying a high multiple because it expects the company to become much larger in the future. But the risk is simple. If growth slows, the multiple can compress. That means the stock can drop even if the company is still good. Scenario 3, low P/E, deteriorating business. This is the trap. The stock looks cheap, but earnings may be falling, guidance may be weak, margins may be under pressure, or the company may be in a shrinking industry. If the E in P/E is falling, the stock may not be cheap at all. It may just be correctly pricing a weaker future. So how should StockIQ use P/E? First, compare P/E to the company's own history. Is the stock cheaper than it usually is, or is the business quality changing? Second, compare P/E to sector peers. A software company, a bank, a utility, and a cyclical semiconductor stock should not be judged by the same multiple. Third, compare P/E to growth. A company growing earnings 20% per year can justify a different multiple than a company growing 2% per year. Fourth, check earnings quality. Are earnings backed by real cash flow? Are margins stable? Is revenue growing? Or are earnings being helped by one-time items? Let's use simple examples. Microsoft often trades at a premium P/E because it has recurring revenue, strong margins, cloud growth, and a durable moat. A cyclical stock may look cheap near peak earnings, but if earnings are about to fall, the P/E can be misleading. And a fast-growing AI stock may look expensive today, but the market may be pricing in much higher future earnings. None of these are automatic buy or sell signals. P/E is a starting point, not a decision by itself. Before buying, ask, is the P/E high because the business is excellent or because investors are too excited? Is the P/E low because the stock is overlooked or because the business is weakening? And most importantly, what has to happen for the current P/E to make sense? That is the StockIQ way to use valuation. Do not ask only whether the P/E is high or low.
Ask whether the earnings, growth, quality, and risk justify the multiple. That is how P/E becomes a decision tool instead of a number on a screen.